through your company, you have so much insight into energy and the energy transition. We're talking about some of these metals. They're commodities, so therefore they're cyclical. Where are we at in that cycle?
So anytime mining stocks or commodity prices do well is because you have more demand than supply. And that's fundamentally what we're seeing on the energy transition metals, which are chiefly copper, but also nickel, lithium, and cobalt. And when we look at all of the competitive battery chemistries today, about 80% of those options for how we make batteries in this world include copper, lithium, and nickel. The issue with lithium is that it's one of the most plentiful elements on the periodic table. And so it's really a question of the technology that will ultimately fuel the energy transition for the refining of lithium, not the discovery of it. Copper and nickel are different. It's much more resource limited, and really, the fundamental issue is that mining capex is down 40% since 2013 in nominal terms. So if you think about it in real terms, even more. And exploration for key metals that will fuel the energy transition is down, 30%.
Okay. So I want to get back to the investor impact here. So when you talk about that decline in capex especially, what does that mean for investors who are trying to, invest in the global supply, obviously benefit from the idea that supply may be limited? Does that mean that right now is the time to invest?
Yeah, you can see with the volatility, especially with some of the key metals, that you have this shark fin of demand that's coming, and you don't have the mining companies investing in supply, and so that will put pressure on pricing. If you look at, gold stocks, which gold is a precious metal, obviously not involved in the energy transition, but they're trading at roughly 4.5 times EBITDA. Copper, which is the key metal for the energy transition because of the conductivity of that metal, is trading, those stocks are trading at like 6.5 times EBITDA. So you're buying in at a little premium, but you literally have an energy transition that will not happen without copper. And if you look on the websites of these companies, you can see the mining sector really understands that it is the rate limiting factor.
It sounds like even with a lot of these upside moves when it comes to copper, that's where you see the biggest continued upside going forward.
There's no replacement for copper in a battery or in power transmission that has the risk of fire.
Right.
And it is the second most conductive element on the periodic table, and that's what the energy transition is about. It's about getting connectivity through batteries, through power, to hook up wind and solar.
So investors are looking for opportunities. They're also trying to mitigate risk. Something that you're looking at is basically nationalism when it comes to these commodity markets. You gave us some great stats. Chile and Peru, they have about 36% of the global copper supply, speaking about what you're talking about. Then you look at nickel, 30% is concentrated in Indonesia. As investors look at this, is this a concern? I mean, how should they view the fact that the sourcing of some of these key metals is really concentrated in certain geographic areas?
Well, I think two things. One, that means you have big supply risk around certain jurisdictions, like we've seen Chile and Peru be much more activist in controlling copper supply, renegotiating with producers. So, of course, when we're investing in natural resources, we always want to be careful about political risk, but it also means that you have big, powerful producers that, provide oligopoly. It's like an oligopoly control over the market, much like OPEC does with oil.
All right,
and actually, Indonesia, which does control 30% of nickel supply, is currently looking at forming a nickel cartel.
So it sounds like the bottom line is copper's the place to be.
I think the energy transition is the place to be, and this is probably the energy transition trade that's not priced in.